Good afternoon, everybody. Directorate General of Taxpayer Services has always been in the forefront in taking the important policy framework of the Government of India in taxation matters directly to the taxpayer doorsteps. In this regard, DGTS has been regularly conducting webinars and outreach programs on various subjects that are of immediate relevance, interest, or importance to the trade importers and exporters. Today's webinar topic is recommendations of 55th GST Council meeting, which is being conducted in association with the Confederation of Indian Industry, that is CII Southern Region, Agra Trade Association, Tamil Nadu. Is yet another initiative in our endeavor to handhold the taxpayer in taxation matters and to further increasing their ease of doing business. I am Mr. Y.V. Khanna, Additional Assistant Director of DGTS Chennai, your moderator for the session. It is informed that the mic is muted and the camera disabled for all the participants other than the speakers in the session. Mic is muted to avoid any unintended audio interruptions so that the speaker is audible to all, and camera is disabled to avoid bandwidth related issues and to have an interruption free session. However, the chat box is enabled for all and the participants can register their questions, queries, doubts in the chat box during the course of the session. During the question and answer session that follows the main presentation, these queries, doubts that are registered in the chat box will be taken up and answered, clarified by the topic speaker. It is requested that the questions, queries, doubts be restricted only to the topic of today's webinar. I repeat, it is requested that the questions, queries, doubts be restricted only to the topic of today's webinar. Due to some other official engagement, our Principal Additional Director General is not able to attend today's webinar, but Sir has sent his valuable speech. The same I will share with you. Good afternoon, everyone. I warm a warm welcome to all of you. Today's webinar is focused on recommendations of 55th GST Council meeting. The 55th GST Council meeting has introduced several key measures aimed at easing the compliance burden on taxpayers. Notably, the uh, threshold for mandatory e-invoicing has been increased, offering relief to small and medium sized businesses. Additionally, the council has focused on simplifying GST rates, reducing ambiguity, and ensuring smoother tax processes. These steps are designed to enhance taxpayer convenience, promote, promote digital compliance, and create a more transparent and efficient tax environment benefiting taxpayers across various sectors, particularly MSMEs. It was a wonderful insight by our principal ADG, sir. May I now call upon Sri Sumit Kedia, member, Economic Affairs and Advisory Panel, CII, to deliver the guest address, please.
Yes, sir. A
Sir?
very good afternoon.
Yes, sir.
Yes, sir. So, 55th GST Council meeting, some of the very important um, clarifications or proposals have come in this meeting. Uh, this meeting got very famous because of various reasons. Um, somewhere it was being circulated because of the issue of popcorn, but on the other hand, there were a lot of critical issues which were being clarified in this GST Council meeting. One of the major issues which was clarified was regarding the definition of plant or machinery or plant and machinery. See, basically, we all know the judgment of Safari Retreat, where, let's say, example, when I'm constructing a mall and the shops are let out on rent, whether the input tax credit on the construction is allowed or not. So, Section 17(5), Clause C and Clause D, with along with the explanation, there was a restriction to claim input tax credit on the construction items. But High Court has confirmed that you can take credit, and thereafter it was in the Supreme Court, and then there was a clarity that input credit can be claimed, but subject to certain more interpretations, where they discussed about plant and machinery, etc. So to put those confusions or disputes to rest, now in the GST Council meeting, they proposed an amendment in the clause D of section 17(5) to replace plant or machinery with plant and machinery. So after that, I think the Supreme Court judgment becomes very clear that I cannot claim input tax credit on the construction items. So since there was a lot of disputes and a lot of writ petitions filed across the country in last 3-4 years on this particular issue, this has come at least with a clarity as to what is to be done. There are other amendments, other proposals also, like on sale of old or used vehicles, sponsorship services rendered by companies brought in under forward charge. One new entry is being inserted in Schedule 3, where they are saying supply of warehouse goods by SEZ or FTWZ will also be form part of Schedule 3, which will neither be supply of goods nor supply of services. See, presently, if I'm supplying custom bonded warehouse goods which are stored in custom bonded warehouse, it becomes part of Schedule 3. So at par, they've inserted this new entry. So likewise, various amendments are proposed, various clarifications are there in the GST Council meeting. Our very learned and favorite speaker, Shivasan sir, is there. So he will throw light on all the amendments. So thank you, sir, and thank you, DGTS, for organizing such awareness programs again and again for the benefit of the entire industry and trade. Thank you, sir, and over to you.
Yeah. Thank you so much for kind words of appreciation. Your suggestions will be taken to the appropriate forum for suitable action. Now, may I call upon Sri Sunil Kumar Sharaf, President, Agra Trade Association, Tamil Nadu, to deliver the guest address, please.
Good afternoon, everyone. Before we dive into today's discussion, I'd like to extend my heartfelt thanks to DGTPS Chennai Zonal Unit and CII for organizing this event and bringing us all together. Your effort in fostering collaboration and knowledge sharing are truly commendable. I serve as the president of Agra Trade Association Chennai, where we conduct regular events, workshops, and educate our members with the latest business trends, provide motivational speeches by industrial leaders, and now we are discussing about the GST recommendations. Our association has over 350 members, consisting of traders, industrialists, and professionals, collectively contributing more than 10,000 crores of business yearly in Tamil Nadu. Today's webinar topic is crucial and as it impacts our economic landscape and the way we conduct business. Our aim is to gain insight, share perspectives, and explore the implication of these recommendations. As we embark on the discussion, I encourage you all to actively participate, ask questions, and share your thoughts. This is a unique opportunity for us to learn from each other and pave way for a more informed and effective implication of GST recommendation. Let's all make the most of today's opportunity and do the needful. Thank you to one and all.
Yeah. Thank you so much for the kind words of appreciation. Your suggestions will be taken to the appropriate forum for suitable action. We have now come to the main part of the program today. To take the topic presentation, we have with us a very distinguished person a man of varied interest, Sri R. Srivasan, IRS Assistant Director, NASIN, ZTI, Chennai. Sir has a rich experience in the department. He is the recipient of the Presidential Award for Distinguished Service and he is well known as a reputed trainer in GST matters. May I now call upon Sri R. Srivasan, IRS, to make the presentation, please, sir.
Thank you, Mr. Khanna, for that
Yes, sir.
kind introduction. First of all, no, let me begin before I begin this session. Let me place my sincere gratitude to the Principal Additional Director General, DGTS, as well as the Additional Director General, NES in Chennai, for having provided me this opportunity to make a presentation with the participants of today's seminar. We know that every GST Council meeting is very important and it brings a lot of relevance to not only to the tax officers but also to the stakeholders and business entities. And 55th GST Council meeting is no exception from that. As during the course of his introductory speech, Mr. Sumit Kedia had in fact said that every GST Council meeting brings in a lot of changes, especially with reference to ease of doing business and ensuring better tax compliance. 55th GST Council meeting also had brought a lot of changes which will facilitate and help taxpayers with clarity and certainty with reference to tax compliances. So in order to assimilate the important recommendations of the GST Council, let me make a PowerPoint presentation so that it is visually attractive also. And also it will be able to help me to make the objective of the presentation in a better manner so that the recommendations are taken in the right spirit and with the proper objective that is with which such recommendations were made. So let me share this PowerPoint presentation. Yeah. Yes, I hope the presentation is visible to everybody, and one line of confirmation will help me to proceed further.
Yes, we can see.
Yeah, thank you very much. Thank you very much. So what I will be dwelling upon today is the recommendations that was made by the 55th GST Council meeting. And to begin with, let me recollect that this meeting was held on 21st of December 2024 at Jaisalmer, Rajasthan. And the recommendations of the 55th GST Council meeting, in fact, included a lot of changes with reference to trade facilitation, changes with reference to policy and procedures, changes relating to taxability and definitions, and of course there were a little bit of rate changes also. So I'll be covering my presentation in these four silos, and the basis for this presentation is the press note that was released after conclusion of the GST Council meeting, and also the notifications and the circulars that were issued on the basis of the recommendations made by the apex body. There were a lot of expectations with reference to certain areas which the stakeholders felt that the GST Council might take a decision, but three important aspects for the decisions have been deferred. One is about the overall rate rationalization, which was anxiously looked upon by all the stakeholders, whether there will be any reduction in the number of rate of taxes or whether there will be a reduction in the rate of tax slabs, so on and so forth. That a decision with reference to that has been deferred. There was also a lot of expectation with reference to reduction in the rate of tax or streamlining the rate of tax with reference to life and health insurance premium. That decision has also been deferred. And what will happen after the expiry of the time limits prescribed for collection of compensation as on March 2026. So that decision also has been given to a group of ministers who will be coming up with their plan, and then a finality will be reached on how or whether to collect at all the compensation cess or not. So this is in effect what is in store as far as today's session is concerned. So let me straight away go into the topic first. Right. So I know even during the course of the introductory speech, a comment was made with reference to one of the very important aspects of input tax credit on construction of immovable properties. A sensational decision was taken by the Apex Court in case of the Safari Retreats case. The entire dispute lies on the fact whether the input tax credit can be made available to the construction industry per se or not. In terms of Section 17(5), Clause C and D, the construction services are blocked credits, which means no, they are not eligible for taking credit, in spite of the fact that they satisfy all the conditions of eligibility and applicability in terms of Section 16(2), by virtue of the fact that they are in relation to immovable properties, and similarly a works contract also. So these two areas, ITC has been blocked for such suppliers of services. The decision went to the department under dispute, and the Orissa High Court said that plant and machinery are eligible for. The input tax credit is eligible for construction industry if they are treated as plant and machinery. And the Supreme Court also said that a functionality test will have to be done, whether plant can be classified as the immobile property can be classified as plant or not. They've taken clue from one of the very important income tax judgment in the case of Taj Mahal Hotel versus Union of India, where the Apex Court held that the definition of plant includes small warehouses also. So principally, the functionality test revolves around the fact whether the immobile property which has been built by such construction service providers is for sale of immobile property or for uh, renting or leasing, which is part of the business and is treated as supply of services. So if the immobile property which has been built on which there is a tax liability on inputs into services and ITC has been blocked, in such situations, if it passes the functionality test and qualify as plant, the Supreme Court said that probably they are eligible for taking input tax credit, because the explanation to Clause C and Clause D, if you can see, under Clause C, it says plant or machinery instead of plant and machinery. If you could surf through the entire GST legislation, you can find that the word plant and machinery finds itself in about 11 places. Out of those 11 places, in 10 places, the reference that has been made is as plant and machinery, whereas only under Clause C of Section 17(5), it has been made as plant or machinery, which gives a small facility or a concession for interpretation by the Honorable Supreme Court to allow it for the input tax credit. So taking clue under that, the Supreme Court decided that if the constructed building passes this functionality test, that is, if it is allowed as supply of services of renting and leasing, then they may become eligible for the input tax credit. But now GST Council has very categorically and retrospectively clarified the fact that the presence of the word plant or machinery will be replaced by plant and machinery, so that there is no ambiguity with reference to blocking of credit, with reference to construction industry under 17(5)(c), and with reference to works contract under 17(5)(d). It was made very clear that there was never an intent to give credit for immobile property, because the definition of goods does not take into cognizance immobile properties transactions, and therefore no GST has kept the transaction in immobile properties outside its ambit, and therefore ITC also does not become eligible for them. So this is in totality what the input tax credit on construction and immobile property is concerned. Therefore, it has been decided to amend the provisions of the law 17(5)(c) to make it plant and machinery instead of plant or machinery, and therefore the intent of the legislation in disallowing or blocking the input tax credit with reference to immobile property is held without any difficulty or without any litigations. But on the flip side, the best part of the judgment was these qualifying the constitutional validity of blocking credit that has been upheld. The court stated that 17(5)(d), which deals with the blocking of input tax credit per se has constitutional validity, and therefore no, that need not be tested again. So this is in fact the best part of the judgment, because there is a legislative confirmation given by the apex court saying that blocked credit is not violative of the principles of equality under Article 14 of the Constitution of India. So now the latest development is that a review petition has been filed in the Honorable Supreme Court on 7th of January 2025 by the government to look into the matter and give a revise, or probably no, there is a prayer for revision of the decision that was given by the apex court earlier. So this is in effect the subject of input tax credit on construction of immovable property. This was one of the most discussed aspect after the GST Council's press recommendations were given as a press note on 21st of December 2024. Next, very important topic is, I'm not going exactly how the press note was released, though that was the basis and fundamental on which my entire presentation actually rests on, but I've taken on the basis of the topics of preference, or no, the topics that were most discussed after the recommendations were made. So the second very important point which was discussed for quite some time is about the taxability of vouchers. We know that vouchers are actionable claims, and vouchers can be redeemed at the time when they are presented before the person who gave those vouchers. And vouchers, whether they have to be treated as supply or not, was the point of dispute or the question that requires to be answered. So the crux of the matter is whether the transaction in vouchers is taxable under GST or not. So GST Council, 55th Council, very categorically stated and clarified the point that vouchers are not to be treated as supply of goods or supply of services, and GST will not apply to the distribution of vouchers on principal basis. We know that vouchers are actionable claims, as I said just before, and the definition of goods includes actionable claims also. But if you see the provisions of Schedule 3 of the CGST Act, which treats any supply neither as supply of goods nor supply of services, actionable claims other than betting, gambling, and lottery are treated as neither supply of goods or supply of services. So thinking with that, the voucher transaction, when it happens or distributed on principal to principal basis, will not be taxable under GST. However, one should note the point that any additional services like advertising services or co-branding services or promotional services or market support services that are associated with vouchers, which are in receipt of the consideration between the supplier and the recipient, then such consideration will attract GST. Per se, taxability of vouchers will not be that they have been kept outside the ambit of GST. That is on principal to principal basis. If vouchers are done on agent-based distribution, such transaction, if there is any commission or fee that is charged by the agents for distribution of the vouchers, then it becomes principal to agent based transaction rather than principal to principal based transactions. In such situations, the commission received by such agents will be liable for GST. Vouchers, not every time all vouchers are redeemed. A lot of vouchers go unredeemed also. They are also called as breakages, and such income are booked as part of the transaction of accounts or as per the Indian accounting standards in the financial accounts. So unredeemed vouchers, even if it is on principal to principal basis, they will not be liable for payment of GST. So that was the third clarification that was given, or recommendation that was given. So all these actually aligns with the judicial principles, especially the decisions that were given by the High Court of Karnataka, where they said that vouchers are akin to prepaid instruments. They are all actionable claims, negotiable instruments, and not taxable as goods and services until they are redeemed, reinforcing the non-taxable status of GST. So once the taxability of vouchers has been clarified that they are not taxable if they are on principal to principal basis, special provisions that are associated with the transactions in vouchers like Section 12(4), which speaks about time of supply, Section 13(4), which also speaks about the time of supply with reference to services under the CGST Act, as well as Rule 32.6, which speaks about the valuation of vouchers, how the vouchers should be evaluated for transaction value, have all been recommended for its omission in alignment with the judicial rulings as well as the GST recommendation. The impact of this recommendation is that it eliminates GST on voucher transactions, reduces the tax liability for business entities, and also aligns itself harmoniously with the judicial rulings, simplifying the tax compliances. So, on the basis of the recommendation of the GST Council, the circular has been issued, circular number 243, dated 31st December 2024. Recommendation has been made, and the circular gives much more clarity with reference to the taxability of vouchers. Third, again, very important point of dispute that was prevailing across with reference to transactions inside special economic zones or free trade warehousing zones. A reference was also made by Honorable Smith Kedia sir during his inaugural speech, where he said that the transactions inside an SEZ and free trade warehousing zones are generally not treated on par with the transactions that happens with customs bonded warehouse, because customs bonded warehouse and FTWs are not treated on par as per the GST legislation, and they are required a harmonious understanding of both transactions. Though the transactions that are made to an SEZ unit by a DTA unit or to a free trade warehousing zone, which is also treated as an SEZ unit, such transactions are treated as zero rated supply. But when the transaction happens within FTWs or within SEZs, more appropriately, FTWs were under point of discussion because they were not treated as or not considered as customs bonded warehouse transactions. So there was no clarity regarding the leviability of GST on such transactions. Now, a clarification has been given that the transactions in FTWs and within special economic zones are to be treated as transactions outside Indian territory and are exempted from duties of GST until they are cleared for home consumption, when it is treated as an interstate transaction and IGST is payable. So this proposed amendment will be by insertion of a new clause, clause AA of entry number 8 of Schedule 3 of the CGST Act, to include transactions in SEZ as neither supply of goods nor supply of services. The best part of this amendment is that it will be done on retrospective basis from 1st of July 2017, and therefore whatever has happened earlier will also be covered, and there will not be any break in the character of transactions within free trade warehousing zones ever since introduction of GST on 1st of July 2017. So the amendment aligns the treatment of FTWs transactions with bonded warehouses, mitigating the tax liabilities, reducing the litigation, and of course, facilitating trade for better compliance. So this again was a long-term requirement which has now been resolved by the GST Council in its 55th meeting. We know that generally the liability to pay tax is on the supplier, whereas there are certain specified services which are covered in terms of subsection 9(3), 9(4), and 9(5), where the recipient is made liable for paying taxes rather than the supplier. In such situations, the supplies or the suppliers or the aggregators who have been specified in terms of 9(3), 9(4), and 9(5), in such situations, the buyer or the recipient of that supply are made liable to pay tax, which is called reverse charge mechanism, as I said. One of the specified services under reverse charge mechanism was sponsorship services. We know that sponsorship service involves financial and other support in exchange of promotional benefits, with GST generally applicable at the rate of 18%. Of course, there are certain transactions relating to cultural and artistic events which attracts 12% GST. So the current mechanism is that sponsorship services to a body corporate or partnership firms which are registered under GST is under reverse charge mechanism, making the recipient responsible for paying GST. See, the GST Council has now proposed shifting of this responsibility from the recipient to the supplier, which means that it will be under forward charge mechanism, making the supplier sponsorer liable for paying GST instead of the recipient sponsored. See, the best fact or the best benefit that is derived, the key benefit that is derived because of the shift is that point number one, it simplifies the compliances for recipients. They need not look for discharging the liability under reverse charge mechanism. At the same time, it also allows the suppliers to utilize the input tax credit for discharging their supplies under forward charge mechanism that is available unutilized in their books of accounts or the electronic credit ledger. We know that if there is a liability to pay tax under reverse charge mechanism, it cannot be discharged using input tax credit. However, now that it has been made as under forward charge mechanism, the supplier sponsorer can pay the tax under input tax credit adjustment. At the same time, the recipient sponsored will also be able to take credit of such tax paid instantly if it is being used in the course or furtherance of business. So the total impact in this is that the ITC remains unaffected. It allows the sponsors to offset their GST liability using the available input tax credit, and the recipient also instantly gets his ITC for further discharge. So it is a win-win situation both for the supplier sponsor as well as the recipient sponsor. So this, in fact, is one of to be treated as one of the most taxpayer-friendly measure that has been taken as part of the GST Council. The fifth point that it attracts all our attention is with reference to renting of immovable properties other than residential dwelling, especially when it is rented to a composition of the. We know that from 1st of October 2024, the registered tenants are liable to pay GST under the reverse charge mechanism if it is renting of commercial properties when it is rented by an unregistered landlord. So if the landlord is an unregistered person and the commercial property is rented to a tenant who is a registered person, from 1st of October 2024, the registered recipient tenant is liable to pay taxes under reverse charge mechanism. The applicable rate of tax for renting of commercial services is at the rate of 18%. But the problem here is that uh, if an unregistered landlord rents his commercial property to a registered taxpayer who has opted for composition levy scheme, then the problem with the composition optee is that he will have to pay taxes under reverse charge mechanism as a normal taxpayer at the rate of 18%. But having opted for composition levy scheme, he is not eligible to utilize, or he is not per se eligible to take input tax credit. Therefore, no, this 18% will have to be paid only by cash, which cannot be used for subsequent discharging of liability using input tax credit. Because if he is a composition optee, he cannot avail input tax credit. That is one of the very important conditions to be a composition optee, because of the reduced rate of taxes and reduced compliance obligations with respect to such small taxpayers. This difficulty was expressed by trade and industry, and government has extended its benevolent ears to that, and they have excluded the composition taxpayers from discharging this liability. Circular number 245 has been issued, and under para 8, they have very clearly said that the composition taxpayers are excluded from the liability to pay GST under reverse charge mechanism for renting of immovable properties from an unregistered landlord except residential dwelling. So past practices, what happens now, because it came into effect from 1st of October 2024, whereas the clarification was given only on the basis of the 55th GST Council meeting. So what will happen to point number one, if I had already discharged the tax liability from 1st of October 2024, or no, I have not discharged the tax liability because no, I did not have enough financial arrangements for discharging this tax liability. It has also been said as a matter of facilitation that all the past practices, which in fact began from 1st of October 2024, will be regularized on as-is where-is basis, ensuring that historical transactions here will not be liable for tax and will be treated appropriately. But if somebody has already paid tax from 1st of October 2024, it will not be eligible for claiming refund with reference to that. So what impact it has made for the composition taxpayers is that the composition optive who must pay this GST in cash without claiming input tax credit, which complicates their compliance and defeats the per se the scheme of composition levy scheme. After this clarification, the simplified tax obligation compulsions are actually restored for them. So this is one more example where the government generally takes a very proactive step, hears the taxpayers and ensures that tax compliances are quite simple, especially for small and medium sector taxpayers. We know again one more very important change that has been brought in, or a facility that has been brought in from 1st of October 2024 is called invoice management system. So GSTN, that is the network partner of GST compliance, has introduced a specific system called invoice management system, which will help the taxpayers match their invoices for accurate input tax credit. One of the most disputed subjects as far as GST is concerned is input tax credit, its applicability, availability, and utilization. But having introduced this invoice management system, it is expected that all such litigations will be brought down because the invoices between the supplier and the recipient will be matched, validated by the recipient, and therefore, no, it will bring down the litigation with reference to input tax credit. This facility has been brought from the October tax period, to be more precise, from 1st of October 2024, and the first IMS got populated in every taxpayer's dashboard on 14th of November, which pertains to the tax period of October 2024. What the taxpayer will have to do is either he has to accept, reject, or keep pending the invoices that are populated in the invoice management system. And if he rejects or keeps it pending, it will not be part of GSTR 2B, because after 1st of January 2022, after introduction of subsection or subclause BA of section 16.2, input tax credit becomes eligible only if it gets auto-populated in GSTR 2B. If an entry is not found in GSTR 2B, then the taxpayer will not be able to take input tax credit without dispute. Therefore, in order to facilitate such a measure, such a legislative self-policing mechanism, this invoice management system has been brought in, which is an additional facility for the taxpayer. At present, it is only optional because all the invoices that are populated in invoice management system, there is no compulsion for a taxpayer to keep on accepting them. If no action is taken, it is considered as deemed acceptance and it will proceed to GSTR 2B, and which can be taken as credit. So at present, it is only optional, but considering the advantages and benefits that the taxpayers will derive out of this invoice management system, it has been decided to give a legislative competence for that, and amendments to sync with the compulsion or obligation for going through the invoice management process has been made, and therefore the provisions of section 68, section 38, rule 60, section 34 to 67b and 39.1 are recommended to be amended, which all will have impacts on the eligibility and availability of input tax credit through invoice management system. So the legislative authority or legislative framework of the invoice management system will enhance transparency as well as taxpayer facilitation. So what impact it will have for the taxpayers? Obviously, these changes will streamline the entire ITC ecosystem. It will bring in a concept called self-policing mechanism, where the buyer will be able to identify whether his GSTN has been misused or whether he is eligible for taking credit per se at the invoice management system level point itself, instead of going it through the process of GSTR 2B and then GSTR 3B and then landing in litigations. It will ensure that only verified invoices contribute to the recipient's eligible ITC. It will reduce disputes and improve compliance. essentially these are the benefits that can be derived out of this invoice management system, which will now be given a legislative authority. Next point is about pre-deposit. Government is also very considerate when it comes to bringing down the liability or cost of disputes. At present, in terms of section 107.6, proviso to section 107.6, a pre-deposit of 25% is required to file appeals before the appellate authority, that is Commissioner Appeals, for all those demands which involves only penalty under section 129.3. So if the demand per se is only for imposition of penalty, then the pre-deposit is 25%. Whereas no, when it is with reference to differential payment of tax, when there is a demand of tax, then the pre-deposit is 10%. Therefore, no, there is no harmony with reference to the rate of pre-deposit. Now, the next point is that there is no pre-deposit required to be made while filing an appeal with the GST appellate tribunal when it involves only penalty demands under section 129.3. So this looks a little conflicting across the dispute resolution mechanism, and therefore it has been recommended that the provisions of section 107.6 will be amended to reduce the pre-deposit from 25% to 10%, and that syncs with the regular tax appellate applications, and also to insert a new provision to mandate 10% pre-deposits for appeals before the appellate tribunal by amending section 112H. So this will ensure that there is a reduced financial stress from 25% of pre-deposit to 10% of pre-deposit, and also it makes it more feasible for the taxpayers to challenge the decisions in case they are aggrieved. So the reduction in pre-deposit will obviously lower the financial burden on the taxpayers and encourage them to appeal with the intent of improving the justice delivery system as far as GST is concerned. So this again is a very, very important move that has been taken by the GST Council, recommended by the GST Council, reducing it from 25% to 10%. Input service distributor, this is one of the USPs of GST, because in situations where the head office pays all the service liabilities with reference to the branch offices, the branch office may not be in a position to receive the tax invoices and subsequently claim credit at their end. So whenever there is a payment or whenever there is a receipt of tax invoice at the head office, which includes the services that are rendered to their branch office also, we have a scheme called input service distributor. This is something which the provisions were borrowed from the service tax regime, where we had this scheme of distributing the credit from head office to its branch offices. There were two very important disputes with reference to this: whether a mandatory registration will have to be taken for disbursing ISD credit. The answer is yes. Second is, what will happen to the taxes that are discharged when the head offices is made liable to pay taxes under reverse charge mechanism. So I pay taxes under reverse charge mechanism by cash. Subsequently, after paying that, discharging the tax liability, I become eligible for taking input tax credit at the head office, which requires to be distributed to my branch offices. Whether such credit paid, taxes paid under reverse charge mechanism are also eligible for distribution of credit was one point which was clarified with a positive answer that it can be distributed. Second, it branched out into two disputes. What will happen when it is an intrastate distribution and interstate distribution? Earlier, it was felt that only intrastate RCM transactions are eligible for distribution of IST credit, but now it has been clarified that interstate reverse charge transactions will also be included as part of the ISD scheme and effective from 1st of April 2025. So this will broaden the ISD framework. It enhances the compliance for multi-state operations of a business entity who has got its business footprints in more than one state. It will definitely facilitate efficient input tax management and reduce the compliance obligation. So the expansion of the input service distributor mechanism is a key definition that was taken. Now it is available for all reverse charge taxes paid on reverse charge mechanism, both for intrastate and interstate transactions, and will be effective from 1st of April 2025 to sync with the financial year's transaction. So this will help reducing the cost with reference to common input services. There were a lot of disputes, a lot of difficulties for taxpayers, for unregistered persons who are made liable to pay taxes in certain situations. So if a person takes registration, immediately all the compliance obligations like filing of returns, filing of statement of outward supplies, filing of annual returns, so many compliance obligations comes into play, maintenance of records, so many compliance obligations comes into play. But if this requirement for taking registration is only for a limited purpose to make any tax payment, either with reference to the earlier regime, existing regime, or with reference to the current regime, if there is a requirement to make tax payments, either on his behalf or on behalf of somebody, there was a difficulty in taking registration. Now, for the purpose of uh, uh, temporary purpose of payment of tax, a temporary registration can be taken, and a facilitation measure will be done. In this regard, two new rules have been inserted. Rule 16A has been inserted under the CGST rule, where there is a legislative authority for granting temporary identification number instead of GSTIN number in GST REG 6. So the person not liable to register but is required to make payment of taxes can use this facility. So a new rule has been inserted, Rule 16A. Subsequently, all the rules where a reference with reference to this temporary registration is required have also been amended, like no rule 87. So rule 87.4 will also be amended to incorporate the reference to rule 16A. Therefore, no, the entire legislation is in a harmonized manner. GST REG 6, no, which consequential modifications are required to be made, can also be made after this granting of this temporary registration number or suo motu registration also. So to bring in all these changes, notification has been issued. Notification number 7 of 2025 has already been issued on 23rd January 2025, but the date from which it will take effect will be notified subsequently. It is only that the new rule has been inserted as part of the CGST rules 2017, but the date from which such rule will take effect will be notified separately. So now at present it is only the rule that is available, whereas the process and the procedures will be subsequently made available. Second, next very important tax-friendly measure that has been taken is waiver of late fees with reference to those taxpayers who have filed their annual return but could not file their or did not file their GSTR 9C, which is a reconciliation statement. We know that all taxpayers whose annual aggregate turnover is more than 2 crore rupees in the preceding financial year and who has exceeded this annual aggregate turnover beyond 5 crore rupees up to 2 crore, there is no compliance obligation. 2 crore to 5 crore, it is enough if they file GSTR 9. If that annual aggregate turnover is more than 5 crore rupees, then they will have to file a reconciliation statement along with their annual return GSTR 9. So this reconciliation statement is called GSTR 9C. So in terms of section 47.2, there was a dispute whether the late fee with reference to non-filing of reconciliation statement in form GSTR 9C is covered in terms of section 47.2, because there is no reference under 47.2 with reference to 9C. They have said that in case a taxpayer fails to file his GSTR 9, then late fee will accrue for him. Now it has been clarified that GSTR 9C is part of GSTR 9, and therefore, if somebody has not filed GSTR 9C along with GSTR 9, that will mean that GSTR 9 has not been fully filed, and therefore they will attract late fee under 47.2. The rate of late fee is 200 rupees per day, but capped to 0.5% of the total turnover in a state. So this general penalty also can be levied under section 125 also, where a general penalty up to 25,000 rupees can be imposed. But in order to facilitate the taxpayers, GST Council has brought in, I cannot say it as an amnesty scheme, but a waiver scheme, which says that uh, any taxpayer who has already filed his GSTR 9 but has failed to file his GSTR 9C, if he files it before 31st March 2025. So the date also has been given. If GSTR 9C is filed before 31st March 2025 for all the GSTR 9s that were filed earlier, which covers the period from 2017-18 to 2022-23. 22-23, there is no requirement for them to pay this late fee. So this is a one-time waiver that has been given for those taxpayers who have not filed GSTR 9C when they have filed the GSTR 9, and if GSTR 9 is filed before 31st March 25, they will get a waiver of such late fees. This is a one-time facility that has been provided to them. So this move aims to provide relief to taxpayers by waiving the tax late fees and encouraging them for timely compliance. So a notification also has been issued. Notification number 8 of 2025 has been issued with reference to this, where they have exempted or waived the late fee with reference to GSTR 9C. The next recommendation that was made is with reference to hotel and restaurant services. We know that the transaction value with reference to hotel industries is based on the declared tariff value and not the actual value of transaction. So if there is a rate card and there is a value declared in the rate card, even if the amount that is received by the guest is less by the accommodation service provider, the declared tariff value will always be the transaction value for the purpose of assessment of GST liabilities. Now, the term declared tariff value has been removed, and it will be amended to link the GST rates on hotel accommodation the actual value of supply instead of the declared tariff value. So at present, two rates have been prescribed. One is 18% GST with input tax credit if the value of supply exceeds 7,500 rupees, or the other rate is 5% GST without ITC. The value of supply is below is 7,500 rupees or below. A taxpayer has been given option, even if the tariff value is less than 7,500 rupees, if he wants to avail the input tax credit and pay at the 18% rate, he has to give a declaration at the beginning of the financial year or at the time of registration, whichever is earlier. Have to give a declaration saying that he opts for higher rate of tax and intend to avail the benefits of input tax credit. So the removal of this declared tariff, linking it with the GST rates to the actual value, provides a lot of flexibility and potentially lowers the compliance burden for hotel industry. So this will take effect from 1st of April 2025. Again, to avoid transitional difficulties, it will happen from the financial year 25-26 onwards, that is 1st of April 2025. Next topic is a clarity on the GST rates for used cars. Again, there were a lot of discussions with this point, but I think the press note was very clear in giving clarity for such changes. The used car dealers generally, if the transaction happens between an unregistered person to a registered car dealer, it will not attract GST. The used cars generally attracts 18% rate of tax. What is the change that has been recommended in the GST Council meeting is that the electric vehicles and the small cars means those vehicles whose engine capacity is less than 1200 cc. If these two types of vehicles are sold as used cars, then the rate of tax applicable on them was 12%, whereas for all other vehicles it was 18%. Now this also has been increased to 18% to bring in harmony with reference to such transactions. But that will obviously not increase the cost of transaction, because all the cost of transaction is not on the sale value of the second-hand cars, but on the margin value of the second-hand cars. Margin value or margin scheme has been defined in terms of Rule 32, Sub-Rule 5, which says that GST on used vehicles will be based on the margin between the sale price of the used car and the purchase price of the used car. Only if this difference is positive, it attracts GST, while the negative margins do not attract GST. For instance, if the sale purchase price of a used car is 9 lakh rupees, sale price of the used car is 12 lakh rupees, then the difference between sale price and the purchase price is 12 lakhs minus 9 lakhs, which is 3 lakh rupees, and GST at the rate of 80% will apply only on this 3 lakh rupees and not on the selling price of 12 lakh rupees. But on the flip side, if the purchase price of the used car is 12 lakh rupees, while the sale price it fetches only 9 lakh rupees, like no, he is selling it on loss. In that situation, the difference is a negative margin. Such situations will not attract GST. So let us have a consolidated understanding of the used car transactions. If an unregistered person sells to an unregistered person, the transaction remains non-taxable under GST. If an unregistered person sells to a registered person, then again, no, it is not in the course or furtherance of business. It is out of scope of GST transaction. So then who will get attracted? Only when a registered person sells to an unregistered person. Such resellers will attract GST at the rate of 18%. So if there is somebody who is involved in the business of buying and selling used cars, only he will be impacted and not the unregistered persons who are offering their cars for resale. So these points were very categorically explained both in the press note as well as during the press conference with reference to GST changes of used cars. So this implementation will have a uniform rate of 18% instead of the varied rate of 12% and 18% earlier. And all used cars will have, with absolute clarity and consistency, a taxation based on margin earned by the dealers at the rate of 18%. So there were some misunderstandings that existed regarding the changes as the primary shift was towards margin-based taxation rather than on total value of taxation. So it is not on the sale price. So that is something which everybody should understand. And the provisions of 32(5) is a very clear understanding of the principles of margin scheme. Next is about ready to eat popcorn. So let me not deliberate much on this. I will give only the clarity to the extent what an ultimate consumer actually would like to know, because obviously, popcorns are not industrial. I mean, purchased for industrial purposes. It is always on B2C transactions. So, as consumers of this ready-to-eat popcorn, let us understand one fact that popcorn attracts 3 rates of taxes. One is 5%, the other one is 12%, next one is 18%. So what will attract 12, what will attract 5, and what will attract 18 is what I will be explaining now. So any popcorn that is non-pre-packaged, you just go and buy it across the counter. And if it is an unsweetened popcorn, then it attracts 5% GST. When it is a pre-packaged but labeled popcorn, like you go and buy a popcorn. See, let me also show you here. If you buy this, you will attract 5%. If you buy a pre-packed popcorn, which has a salt flavor, then if it is a pre-packed one, then it attracts 12%. And when it is has a caramelized popcorn, like it has got a sugar coated to it, then it becomes a sweetened confectionery or sugar confectionery with an essential characteristic of sweetness that will attract 18%. So this is something we will have to understand. This was already in existence. There was a small clarification that was given. So if you go and buy a popcorn like this, then it will attract 5%. If the popcorn is pre-packed and salted, it will attract 12%. If the popcorn is caramelized, which carries essential characteristic of sweetness, then it will attract 18%. There is no change in the rates of tax. Consequent upon the GST Council meeting, it was only a clarification that requires to be given as part of the recommendations of the GST Council. Other law changes, amendment to registration for facilitating composition optis. So table 5 of CMP 02 has been synchronized with the form for amendment to registration, uh, bringing in harmony with the category of registered person. So any amendment to registration by the composition optis will become easy now using forms GST CMP 02 and form GST REG 14 essentially is used for amendment purposes. Next, very important aspect is availability of input tax credit on works contract. What happens is that if there is, this was given under the scenario, a clarification that was sought by automobile industry. Generally, the automobile industries follow a practice of supplying goods ex factory. So at the factory gate, the dealer is provided with the ownership and possession rights over the vehicle that they are selling. So in that situation, the question was whether the dealers who are purchasing these cars for subsequent sale, whether they are eligible for input tax credit immediately at the point where the supply is recognized, or whether they have to wait till the goods reach their dealership principal place of business. Because one of the very important conditions in terms of section 16(2)(b), which speaks about eligibility and admissibility of input tax credit, is that the input tax credit with reference to goods is available only after receiving goods, only upon receipt of goods. Whereas here, the right of ownership is changed in the hands of the recipient dealer by the original equipment manufacturer at the factory gate itself. And therefore, to carry these goods from the ex-factory location to the dealership principal place of business probably might take a longer time than one expects, because if probably the manufacturer is in Chennai and the principal place of business of the dealer is in Delhi, and it has to be taken either through road or rail, probably it might take 15-20 days for them to take the credit. This delay probably shifts eligibility to subsequent tax period, and therefore creates a little bit of financial stress as far as payment of tax liabilities are concerned, because they may not have the input tax credit with them. They may not have input tax credit with them immediately on receipt of this goods. So in such situations, it has been clarified under circular number 241 that we can bring in a concept called deemed receipt, where the input tax credit becomes eligible immediately where the transfer of right of ownership is recognized between the OEM supplier and the dealer. So this also facilitates immediate availability of input tax credit on receipt of goods, and they need not wait till the goods are received at the OEM station. So a circular number 241 has been issued clarifying these recommendations by the GST Council. This is a very important and a very broadly interpreted aspect, with a sole intent of facilitating the trade and make them available the input tax credit instantly, so that their financial stress is reduced. Other law changes, they have said that the GSTR 3B shall be filed only after GSTR 2B is made available on the portal, and the portal will facilitate availability of GSTR 2B by 14th of the subsequent month, and GSTR 3B shall be filed only on 20th, 22nd or 24th, depending on the location of the taxpayer. GSTR 3B requires to be filed. So which means that 2B is mandatory for filing 3B, obviously, because they have to take input tax credit, and 2B will also be made available before GSTR 3B is filed. So it helps in sequential filing of returns. We already have this concept of sequential filing of returns. Unless you file GSTR 1, GSTR 3 cannot be filed unless GSTR 3B of the previous tax period is filed, GSTR 1 of the current tax period cannot be filed. So all these things are actually interlinked for self-policing mechanism. Now GSTR 2B has also been brought as part of that synchronization process. There were a lot of disputes with reference to the penal charges that were levied by bank as regulators, and now it has been clarified that under circular number 245, it has been clarified that such penal charges can be treated on par with liquidated damages, and we know that liquidated damages are not liable for GST under after introduction of GST, though there were a lot of disputes with reference to this. Earlier, a circular was issued last year clarifying the fact that liquidated damages are outside the ambit of GST, in line with what was in existence under the service tax regime also. In clarification that was issued under circular number 240 is that the e-commerce operators are not required to reverse input tax credit under section 17.1 and 17.2 because these e-commerce operators are liable to pay tax under reverse charge mechanism when they pay taxes on behalf of the restaurant services. So when like Swiggy or Zomato, they undertake two types of transactions. One is they deliver food from restaurants. They also deliver food items like pre-packed items like the Haldirams, etc. So whenever they act as on behalf of when the supplies are acted on behalf of the restaurant services, these entities are liable to pay tax under reverse charge mechanism. There was a question whether in such situations the proportionate ITC will have to be reversed or not. And it has been clarified that in such situations, when they do both type of transactions, e-commerce operators are not required to reverse the ITC. That is an important, very important clarification that has been given. And with reference to online gaming, OIDAR services, etc., if the recipient is an unregistered person, then it has been made mandatory that the name of the recipient state will have to be declared in the tax invoice. If you can see,
लेकिन उधर तो नेट आ रहा है ना?
हाँ
उधर तो आ ही रहा था.
No, we'll take that. No,
You sit there, sir. No, not an issue. No? You sit here.
I'll bring everything.
I'll bring everything. You sit.
No.
sir, I think
Remaining
Eight. He is waiting for you, sir.
No. Sit. You tell.
Yeah. Yes, now it has been muted. Okay. So there is a compulsion now to mention the name of the recipient state in the tax invoice. If you can see the bills raised by IRCTC, there will be a categorical indication the state from which the recipient has booked the ticket. So that will help record the recipient's address and the place of supply. Therefore, it becomes easy for apportionment of IGST to the consumption state. So the details have in fact been made available under circular number 242, which has been issued on 31st December 2024. There is also a proposal for inserting a new section 148A, where the government intends to bring a concept called track and trace mechanism, where there will be specified evasion prone commodities like the tobacco products, where they will be provided with a unique identification number, and based on this unique identification number, the traceability of these commodities across the supply chain can in fact be maintained. So this proposal was made because of the fact that there was a statistical information that was given by Tobacco Institute of India, which says that the government loses almost 21,000 crore per year due to illegal cigarette transactions. So tobacco products generally have this ignominious distinction of being one of the most evasion-prone commodities, and therefore, government intends to bring this track and trace mechanism with reference to the commodities which are prone for evasion. There are certain rate changes also which has been recommended. So notifications have also been issued. Rate notification 1 to 4 reduces the rate with reference to the following items. The GST rate for fortified rice kernels has been reduced from 12 to 5%. GST on gene therapy, which is used for life-threatening diseases, has been exempted. And IGST exemption has been extended to subsystems and equipments, parts and subparts and tools, which are, and also software, which are meant for assembly or manufacturing of long-range surface-to-air missiles. Then the compensation cess has also been reduced to 0.1% to merchant exporters. So we know that the merchant exporters can pay tax at the rate of 0.25%. The suppliers to merchant exporters can pay tax at the rate of 0.25%. Similarly, this concession with reference to compensation cess is also extended to merchant exporters, which is treated as deemed exports. The exemption is also available for international atomic agencies. All these notifications, all these concessions and exemptions are available and covered under notification 124 of GST rate notification. Further, concessional rate of 5% has been extended to food preparations intended for free distribution of economically weaker section, and general insurance companies which collect motor vehicle accident fund, that has also been exempted from GST. Aerated concrete blocks containing more than 50% of fly ash will attract only 12% instead of 80% earlier. And there were a lot of other amendments also. So one can in fact go through notification 1 to 4 central rate notification, which was issued on 16th of January, to find out what are the rate changes that has been made. Most of the rate changes were downward revision of rates, which in fact can be appreciated that it has been done with an intent to reduce the cost of supply. Right. There are certain policy matters which have not been decided. Procedural rules, the very important anticipated aspect from the stakeholders is establishment of GST appellate tribunal. So the procedural rules are in place. These rules proposed for internal functioning of GSTATs would be notified after examination by law committee, probably, which will not take much of a time, and the much anticipated GST tribunal will start functioning very shortly. That is what the GST Council recommendation has said. Second is regarding rate structuring and composition levy scheme. It has been decided to defer it to the next council meeting. A group of ministers has been formed for restructuring of GST on compensation cess. So that will submit its report by 30th of June, and a decision will be taken, because we know the compensation cess is levied up to March 2026, and therefore no, we have time to decide about the fate of compensation cess. A group of ministers has also been constituted to examine the legal and structural issues with reference to imposition of a special levy in case a state suffers from natural disaster calamity. We know that there was a proposal by the state of Kerala to impose an additional tax element of disaster cess for that particular state. And now subsequently, there were a lot of claims by other states also, which were stressed by the natural disasters. Now a proposal was made by the state of Andhra Pradesh to bring in a concept called natural disaster or calamity cess. A group of ministers has been constituted to examine the legal and structural issues with reference to imposition of this. Then the council also deferred its decision to reduce the GST rate on health and life insurance. It will continue at the rate of 18%, because the OM is yet to decide on the basis of a report that is to be given by the Insurance Regulatory Authority. So once the Insurance Regulatory Authority also gives the report, probably a final decision will be taken on reduction of GST rates on health and life insurance sector. What I would like to emphasize here, after not speaking for almost 60 minutes, is that there are so many changes that has been made, and these changes are required to be meticulously analyzed. Nevertheless, not all the changes are obviously in the interest of trade facilitation. And also, the other very important objective is that it has to synchronize with the economic compulsions of the country also. So it is always better that we meticulously analyze whatever changes has been given, especially the 55th GST Council, which has given a lot of concessions and elbow room for the trade by relaxing the ease of compliance, by reducing the rate of taxes, and also to facilitate a lot of procedural compliances. And more importantly, one should understand that all the recommendations of the GST Council would be given effect. Legislative recommendations of the GST Council would be given effect through relevant circulars, notifications, and of course, the law amendments will come into force from the date to be notified later, because they will have to be synchronized with the SGST Act also. So we will have to wait for the law amendments to take effect little more, whereas whatever has been given, the relevant circulars and the notifications, which very specifically says from which date it becomes operative, so they will take immediate effect. The law amendments will take a little bit of time to be notified to have force of law. So I would like to conclude my presentation here. What I talked today was about the changes for trade facilitation, then changes with reference to policy and procedures, changes relating to tax liability, then GST rate changes, and then policy matters that can be anticipated for the future. I hope you found this presentation useful. I stop sharing the presentation now and leave the dais for question and answer, either through mic or through the chat box. Over to the moderator, please. Thank you very much.
Sir. Sir, thank you, sir, for the wonderful and detailed presentation, which brought a lot of clarity to the topic. The presentation threw a lot of light on the subject and clarified a lot of doubts. We now move on to the question and answer session. Yes, sir. Sunil, sir. Any doubt you can ask, sir.
Sir, everything was much clear, so I don't think we need to ask any doubt.
Thank you for that compliment, sir, from you.
Except for our members have some difficulties always. So if that recommendation goes through you, then maybe we can send a recommendation again.
Yes, sir. You can give your suggestions to DG Taxpayer Services, and they will be taking it to the appropriate forum, sir. That is for sure. And they have been doing it for quite some time. And based on such stakeholders' suggestions, a lot of recommendations have been made in the past also, sir. So they will definitely have the effect and see the light, sir.
Surely, sir. We'll send it, sir.
No doubts has been raised by the other taxpayers, because you have explained everything about 55th GST Council recommendations in detail, sir. Hence, no doubts and queries at all by the taxpayer. Lastly, a special thanks to our speaker, Sri R. Srivasan IRS, for sharing his invaluable insights with us. Your expertise has been truly enriching, sir. I would also like to thank our panelists Sri Sumit Kedia and Sri Sunil Kumar Sharaf for their engaging discussions and thoughtful contributions. Lastly, a big thank you to all the taxpayers attending today. Your participation is what makes this event so meaningful, and we hope you found the session beneficial. We look forward to hosting you again in future webinars. Thank you and have a wonderful day. With that, we have come to the end of the session. Thank you to all.
Thank you, sir. Jai Hind.
Right, sir. Thank you very much.
Jai Hind, sir.
Right.